So the first speaker is Chris Wheldon. He's from Magellan Asset Management, which has had a pretty good run of late. Please welcome Chris to the stage.
Thanks very much, Peter. Can everyone hear me okay? Excellent, very good. Look, I'm just going to give a very, very quick introduction to Magellan. I'm sure many of you have heard of the business, but for those who haven't, Magellan's a Sydney-based global equity manager, and we run 3 strategies there. You can see on the slide, we've got a global equity strategy, a listed infrastructure strategy, and Australian equity strategy as well. If there's any information you want on that, we've got people outside, we've got Emma down the front here. Head to our website, there's plenty of information you can find. What I want to spend some time on is talking about our investment philosophy at Magellan, because core to our investment philosophy is building concentrated portfolios in the world's best businesses, purchased at attractive prices. Which begs the obvious question, why do we adhere to this approach? And the reason is because we believe that over time, the risk and return profile of a portfolio will simply reflect the risk and return profile of the businesses and the investments within that portfolio. And if you want to deliver attractive and reliable returns to investors, as we seek to at Magellan, you have to own businesses with attractive and reliable economics. And that forces us into a universe of high-quality businesses. This is fundamental, this is core to what Magellan does, is we constrain our universe to the very best businesses. Businesses, high returns on capital, very dominant positions in their industries, attractive industries with enduring growth drivers behind them, predictable cash flows, all those sort of things. And what I'm showing on the slide behind me isn't our current portfolio, though we own a few of these businesses currently. What I'm showing is examples of businesses that we regard as being those high-quality, world-class businesses. You'll recognize many of them. And they're grouped into a few buckets corresponding to how we think about the source of each of those companies' economic moat or sustainable competitive advantage. It might be something like switching costs. And here, I'd encourage you to think of a business like Apple and all the various hooks that Apple has into its customers around the world. It started with the iPhone back in 2007, and iPhone users are incredibly loyal to the iPhone. Every couple of years when they buy a new phone, it is the iPhone that they purchase. But as we fast forward to today, the iPhone user still has their iPhone, but they'll also probably have a Mac, they'll have an iPad, they may be wearing the Apple Watch, they may be walking around listening to Apple Music on their AirPods, they might be watching Apple TV at home, even Peter's show on Apple TV. Apple's users are trapped in this ecosystem of products and services. There is no escape, and that's what switching costs look like. Now, another source of competitive advantage can be a very strong brand. And here we want to think about something like Louis Vuitton. Louis Vuitton was created in 1854, over 160 years ago. And since that time, decade after decade, generation after generation, the business behind Louis Vuitton has created associations in our mind for that Louis Vuitton brand. When we think of it, we think of things like status and prestige, craftsmanship, French heritage, all those sort of things. The truth is there are many companies that sell handbags around the world. There's only one company that sells Louis Vuitton handbags. And as we all know, that company charges very, very high prices for its products. It makes very, very attractive margins and economics because of the strength of that brand. And then network effects. I want to bring network effects to life with a case study on Visa. But before doing that, to just explain what network effects are, a network effect exists when an incremental user of a product or a service makes that product or service more valuable to all of the users. And so a classic example that we'll all be familiar with today is Facebook. We all know and probably use Facebook. but many of us have stopped using or indeed may have forgotten MySpace. And that's the point. As Facebook grew, it grew stronger. And of course, that resulted in the collapse of its competitors, like MySpace. And network effects are at the heart of Visa's economic model. And what you can see here on the slide is the two sides of Visa's network. On one side, you have about 3.5 billion Visa cards on issue around the world. Think of that. There are 7 billion people on the planet, about 3.5 billion Visa cards. And on the other side of the network, there are about 50 million merchants all around the world who accept Visa's cards. So you can take that debit card or that credit card and you can use it wherever you go around the world. And what that means is, on an annual basis, there are about 200 billion transactions taking place across Visa's network. That equates to about 6,000 transactions every single second. And Visa clips the ticket on every one of those transactions, and though it charges a very small amount on each transaction, when you're doing hundreds of billions of them a year, that adds up to a lot of money. So not only is Visa's business model highly advantaged, and in fact, because of that advantaged business model, the company earns incredible economics. What I'm going to do here is just deconstruct Visa's growth over the past decade. And it starts with purchase volumes. Now, purchase volumes are the value of all of those transactions that take place across Visa's network every day and every year. And with the transition from cash and check-based payments to card-based payments around the world, Visa's purchase volumes have compounded at 10% for a decade. Now, because of Visa's highly advantaged position in the industry, it has some pricing power. It increases its prices a little every year, such that revenues over the past decade have compounded at 13%. It gets better. Visa's cost structure is largely fixed, so that as these revenues grow, costs don't need to grow quite as fast, so that those incremental revenue dollars are dropping straight through to earnings, generating 18% compound operating profit growth for a decade. And last but not least, not only is the cost structure fixed, but Visa's growth requires very little retention of capital. It doesn't require capital to grow. So those earnings coming out of the business, they don't need to be retained by the company. They get given straight back to shareholders via dividends and via buybacks, such that earnings on a per-share basis after those buybacks have compounded at 23% for over a decade. 23% EPS growth for a decade. We don't think that growth is done. This is the framework that we use when we think forward about Visa's growth prospects. We expect global consumer spending, which is that PCE metric, personal consumption expenditure, global consumer spending, we expect that to continue growing at mid-single digit levels over time, as it has historically. But then you add to that the ongoing transition from cash and check-based payments to card-based payments. You add to that the growth in e-commerce, which is really rocket fuel for this trend, because of course when we're transacting online with Amazon or eBay, we can't give them cash. It has to be a debit card or a credit card we use for that transaction. And then finally, at the bottom on the left-hand side, you can see that Visa is getting into new payment categories. It's opening up its network to new payment flows. Traditionally, it's been a consumer to business model. If I shop at Woolworths, money goes from my account to Woolworths' account. It's a consumer to business model. Visa's network has been expanded to peer-to-peer transactions or business-to-business transactions. All these new payment categories results in an explosion in the addressable market available to Visa. So we've got high conviction that Visa's purchase volumes will continue to compound at double-digit rates into the future. It's a continuation of the economic model that we showed on the last slide. And this can be the investment outcome. When you find these high-quality businesses and you can purchase them at attractive prices, and you can see that in our portfolios at Magellan, we've owned Visa since 2010. You find these advantaged businesses with attractive economics, and you let compounding do its work, you can get these attractive, reliable returns from businesses that we're all familiar with. We all understand what Visa does, and it delivers these sort of returns for us. So just to wrap up, given this is a Switzer listed conference, I just wanted to show a suite of the listed products that we have at Magellan, and we've just added to this just this week. You might have heard about the announcement of our new High Conviction Trust at the bottom of the slide there. And that trust takes our existing philosophies that I've just spoken about, our processes, our disciplines, and what we're doing is we're constructing an 8 to 12 stock portfolio. We call it our best ideas strategy. Now, we've actually had an unlisted high conviction fund in the market for the last 6 years. And since inception through to July this year, that high conviction fund has delivered after fee returns of 16.6% annually over that 6-year period. We're bringing that same strategy to market in a listed product with the High Conviction Trust. So with that, let me wrap up. Let me thank you all very much for time and attention this morning. Just remember, it's the high quality companies around the world that are going to deliver that attractive compounding in your portfolios over time. And as I mentioned earlier, if you're after any more information on Magellan, those products you saw on the last slide, please come and see us afterwards. We've got the booth outside, or head to the website. Thank you very much.
Thanks, mate.